They called it the smartest bank on Wall Street. Lehman Brothers did not just trade stocks. They created complex financial instruments with names like collateralized debt obligations and mortgage-backed securities. They borrowed $30 for every $1 they owned, 30-to-1 leverage. It worked beautifully when housing prices went up. Every trade was profit. Every quarter beat expectations. Until it did not. When housing prices fell just 3%, Lehman's entire capital was wiped out. 30-to-1 works both ways. This is the story of Lehman Brothers, the bank that built a skyscraper on a foundation of sand and discovered gravity still exists. Let us rewind to 1850, a time when America was mostly farmland, when New York was just beginning its rise, when Wall Street was a muddy street of modest buildings. 3 German Jewish brothers arrive in America with nothing but ambition: Henry Lehman, Emanuel Lehman, and Mayer Lehman. They were not bankers. They were merchants. Henry, the eldest, settled in Montgomery, Alabama, and opened a dry goods store in 1844. Cotton was king in the South, and Henry saw opportunity. He started accepting raw cotton as payment from farmers who had no cash. Then he would sell that cotton to textile mills up north, pocketing the difference. It was simple but profitable. When Henry died young in 1855, his brothers Emanuel and Mayer expanded the business. They moved beyond retail and became commodity brokers, trading cotton directly. By 1858, they opened an office in New York City. The Lehman Brothers firm was born. The Civil War from 1861 to 1865 devastated the South, but Lehman Brothers adapted. They diversified from cotton into other commodities: coffee, petroleum, even railroad bonds. After the war, they became members of the New York Stock Exchange and the New York Cotton Exchange. The transition from merchants to bankers was complete. By the early 1900s, Lehman Brothers was a respected name on Wall Street. They underwrote initial public offerings for retailers like Sears and F.W. Woolworth. They financed the growth of American companies like RCA and Studebaker. Through 2 world wars, the Great Depression, and the post-war boom, Lehman survived. 150 years of careful risk management, conservative lending, and client service. But by the 1980s, Wall Street was changing. Deregulation was the new religion. Investment banks that had been partnerships, where partners risked their own money, began going public. In 1994, Lehman Brothers went public too. This shift was profound. When it was a partnership, every partner's personal wealth was on the line. They were careful. After going public, they were managing other people's money.
Shareholders' money?
The incentives changed. Risk-taking was rewarded. Caution was punished. In 1994, the same year Lehman went public, a man named Richard Fuld became CEO. Dick Fuld was not like the old Lehman Brothers partners. He was aggressive, competitive, and obsessed with winning. Colleagues called him the Gorilla, a nickname he seemed to enjoy. Fuld had joined Lehman in 1969 as a commercial paper trader. He climbed the ranks through sheer determination and a willingness to take big bets. Under Fuld's leadership, Lehman Brothers transformed. The conservative investment bank that financed American businesses became a trading powerhouse focused on mortgages and real estate. The strategy was simple: borrow massive amounts of money, buy mortgage-backed securities and real estate, and profit from the spread. It worked spectacularly. From 1994 to 2007, Lehman's revenue grew from $2.7 billion to $59 billion. Profits soared from $413 million to $4.2 billion. The stock price went from $5 to over $80. Dick Fuld became one of the highest-paid CEOs in America, earning over $480 million in total compensation during his tenure. But this growth came with risk. Lehman was leveraging itself at extreme levels. By 2007, for every $1 of equity Lehman owned, they had borrowed $31. This is called leverage, and it is a double-edged sword. When assets go up in value, leverage multiplies your gains. But when assets fall, leverage multiplies your losses. To put this in perspective, if you own a $100,000 house with no mortgage, and the house value drops 10% to $90,000, you lose $10,000. But if you bought that same house with a 90% mortgage, putting down just $10,000, a 10% drop wipes out your entire equity. Lehman was playing this game with hundreds of billions of dollars. To understand Lehman's collapse, we need to understand the subprime mortgage market. The story begins in the late 1990s with a simple idea: expand home ownership. Politicians loved it. Clinton administration, Bush administration both pushed for it. Fannie Mae and Freddie Mac, government-sponsored enterprises, were directed to buy more mortgages from lower-income borrowers. Wall Street saw opportunity. Mortgage lenders like Countrywide and New Century Financial started offering loans to anyone with a pulse. Nina loans, no income, no assets. Ninja loans, no income, no job, no assets. Adjustable rate mortgages with teaser rates. Pay almost nothing for 2 years, then rates skyrocket. These were called subprime mortgages because the borrowers had poor credit scores, low incomes, or shaky employment. They were risky, very risky. But Wall Street had a solution: securitization. Here is how it worked. A mortgage lender would originate thousands of subprime mortgages. Then they would sell those mortgages to an investment bank like Lehman Brothers. Lehman would bundle the mortgages into a pool, then slice that pool into different tranches with different risk levels. The top tranche was supposedly super safe, getting paid first. The bottom tranche was risky, getting paid last. Then Lehman would take these tranches to credit rating agencies like Moody's and Standard & Poor's. The agencies would rate them. Incredibly, the top tranches got AAA ratings, the same rating as United States Treasury bonds. How? The logic was that even if some mortgages defaulted, the pool was diversified across different geographies and borrower types. Defaults would not all happen at once. It was statistically impossible, or so they said. Lehman and other banks sold these mortgage-backed securities to investors worldwide: pension funds, insurance companies, foreign banks, even other investment banks. Everyone wanted them because they paid higher yields than treasury bonds but supposedly carried the same risk. It seemed like free money. Lehman was not just packaging mortgages. They were buying them too, lots of them. By 2007, Lehman owned over $40 billion worth of subprime mortgages and mortgage-backed securities. They also owned $85 billion in other real estate assets. Lehman had become a giant real estate hedge fund masquerading as an investment bank. By 2005, cracks were appearing. Housing prices, which had been rising for years, started slowing. Homeowners who had taken out adjustable-rate mortgages with low teaser rates began facing rate resets. Their monthly payments doubled or tripled. Many could not pay. Defaults started rising. In 2006, housing prices stopped rising altogether. Then they started falling. Subprime mortgage defaults accelerated. Lenders like New Century Financial, which had originated billions in subprime loans, went bankrupt. The secondary market for mortgage-backed securities began freezing. Buyers disappeared. Inside Lehman, some traders saw the danger. They warned senior management. One risk manager, Madeline Antoncic, raised red flags about the firm's real estate exposure and extreme leverage. She was ignored. Another executive, Michael Gelband, head of fixed income, recommended reducing real estate positions. He was pushed out in 2007. Dick Fuld and his inner circle, including Chief Financial Officer Chris O'Meara and Chief Operating Officer Joe Gregory, believed housing was a temporary blip. They doubled down. While other banks like Goldman Sachs began hedging their mortgage exposure, Lehman kept buying. By the end of 2007, Lehman's real estate exposure was larger than ever. March 2008. Bear Stearns, the fifth largest investment bank in America, was in trouble. Like Lehman, Bear had loaded up on subprime mortgages. Like Lehman, Bear was highly leveraged, 33-1. When the mortgage market froze, Bear could not sell its holdings. Worse, Bear relied on short-term loans called repo financing to fund its operations. Every day, Bear borrowed billions overnight from other banks using its mortgage securities as collateral. But in March 2008, the other banks got nervous. What if Bear's mortgage collateral was worthless? They stopped lending. This is called a run on the bank, except it was happening in the shadows, in the overnight lending market. Without funding, Bear Stearns had 48 hours before it would collapse. The Federal Reserve and Treasury Department faced a choice: let Bear fail or bail them out. They chose bailout. The Fed arranged for J.P. Morgan Chase to buy Bear Stearns for $2 per share, down from $170 a year earlier. The Fed also lent $30 billion to facilitate the deal. Bear Stearns was saved. Sort of. The message to Wall Street was clear. The government would not let a major investment bank fail. Too big to fail was real. Dick Fuld watched Bear's rescue and felt reassured. Lehman was bigger than Bear. Fourth largest investment bank. Surely if Lehman got in trouble, the government would step in. Spring and summer 2008 were brutal for Lehman. Housing prices were now in free fall, down 15% from their peak. Lehman's $40 billion in subprime mortgages were hemorrhaging value. Every quarter, Lehman had to write down billions in losses. In June 2008, Lehman announced a second quarter loss of $2.8 billion. The stock price, which had been $65 in 2007, fell to $20. Credit rating agencies downgraded Lehman's debt. Short sellers, investors betting against the stock, circled like sharks. Dick Fuld was defiant. In internal meetings, he raged against short sellers, calling them attackers trying to destroy the firm. He vowed to fight back, but privately he was scrambling. Lehman needed capital. Fast. They tried raising money by selling assets and issuing new stock. They sold their investment management division for $2 billion. They raised $4 billion in capital from investors in Asia and the Middle East. But it was not enough. Lehman's leverage was still over 30-1. Their real estate holdings were still massive. And the market knew it. Every week, rumors spread that Lehman was next. Their stock kept falling. By September 2008, it was under $10. Fuld had another problem. Potential buyers were scarce. Bank of America looked at Lehman but walked away. Barclays, a British bank, expressed interest but needed time for due diligence. The Korean Development Bank was rumored to be interested, but talks collapsed. Nobody wanted to buy a bank stuffed with toxic real estate. Friday, September 12, 2008. Lehman Brothers stock closed at $3.65. The company's market cap was $1 billion, down from $45 billion a year earlier. Lehman had $130 billion in debt coming due. They could not roll it over. The firm was hours from insolvency. That evening, Treasury Secretary Hank Paulson, a former Goldman Sachs CEO, called an emergency meeting at the Federal Reserve Bank of New York. Every major Wall Street CEO attended: Jamie Dimon from J.P. Morgan, Lloyd Blankfein from Goldman Sachs, John Mack from Morgan Stanley, Vikram Pandit from Citigroup. Dick Fuld was not invited. Lehman was the patient. The others were there to decide its fate. Paulson's message was blunt. Lehman needs a buyer by Monday. The government will not bail them out. You need to find a private sector solution. The room was stunned. After Bear Stearns was rescued, everyone assumed Lehman would be too. But Paulson, under pressure from critics who said taxpayers should not bail out reckless banks, drew a line. Saturday, September 13th. Two potential buyers remained: Bank of America and Barclays. Bank of America's CEO, Ken Lewis, was interested but wanted government help to absorb Lehman's bad assets. Paulson refused. By Saturday evening, Bank of America walked away. Instead, they bought Merrill Lynch, another investment bank on the brink. Barclays was still interested, but British regulators needed time to approve the deal. They said no. By Sunday afternoon, Barclays withdrew. Sunday, September 14th. Lehman Brothers had no buyer, no government bailout, no options. At 7 p.m., Lehman's board held an emergency meeting and voted to file for bankruptcy. At 1:45 a.m. Monday morning, September 15th, Lehman Brothers Holdings Incorporated filed for Chapter 11 bankruptcy protection. It was the largest bankruptcy in United States history, $613 billion in assets, 25,000 employees, 158 years. Gone. Monday, September 15th, 2008. Markets opened to chaos. Lehman's stock, trading at $3.65 on Friday, was now worth pennies. The Dow Jones Industrial Average dropped 504 points, over 4%, in the first hour. Credit markets froze. Banks stopped lending to each other, terrified that the next Lehman was hiding in their counterparty list. Lehman had been a counterparty to thousands of derivatives contracts: credit default swaps, interest rate swaps, currency forwards. When Lehman filed for bankruptcy, all those contracts were suddenly in limbo. Nobody knew who owed what to whom. The entire financial system, built on trust and counterparty relationships, seized up. AIG, the giant insurance company, was next. AIG had sold credit default swaps on mortgage-backed securities, essentially insurance policies promising to pay if mortgages defaulted. With Lehman's collapse, AIG suddenly owed billions on those swaps. By Tuesday, September 16th, AIG was hours from collapse. This time, the government did intervene. The Federal Reserve lent AIG $85 billion, effectively nationalizing the company. The government now owned 80% of AIG, but the damage was done. On Wednesday, September 17th, a money market fund called the Reserve Primary Fund broke the buck. Money market funds are supposed to be ultra-safe, always worth $1 per share, but Reserve Primary held $785 million in Lehman debt. When Lehman filed for bankruptcy, that debt became worthless. Reserve Primary's shares fell to 97 cents. Investors panicked and yanked their money. A run on money market funds began. Money market funds hold $3 trillion and provide short-term funding to corporations. When the run started, companies could not access cash to make payroll or pay suppliers. The commercial paper market, where companies borrow for 30 to 90 days, froze. General Electric, a AAA-rated company, could not borrow. The real economy was grinding to a halt. By late September 2008, the financial system was on life support. President George W. Bush, Treasury Secretary Hank Paulson, and Federal Reserve Chairman Ben Bernanke faced a stark choice: let the system collapse or intervene with unprecedented force. They chose force. On September 19th, Paulson proposed the Troubled Asset Relief Program, or TARP. The plan: give the Treasury Department $700 billion to buy toxic mortgage assets from banks. The idea was to remove the bad assets from bank balance sheets, restoring confidence. Congress initially voted no. The Dow dropped 777 points in one day, the largest point drop in history. Terrified, Congress passed TARP on October 3rd. But TARP was not enough. The Federal Reserve launched a series of emergency programs. The Commercial Paper Funding Facility bought commercial paper to keep corporations funded. The Term Asset-Backed Securities Loan Facility supported lending. The Fed cut interest rates to zero. They printed money, trillions of dollars. Globally, governments followed suit. The Bank of England, European Central Bank, Bank of Japan, all slashed rates and pumped liquidity. Governments guaranteed bank deposits, nationalized failing banks, and injected capital. The total global response was estimated at $12 trillion in loans, guarantees, and asset purchases. It worked, barely. By early 2009, the free fall stopped. Banks stabilized, credit markets thawed, but the damage to the real economy was catastrophic. In the United States, 8.7 million jobs disappeared. The unemployment rate hit 10%. Housing prices fell 40% from peak. $16 trillion in household wealth vanished. Globally, the Great Recession erased $60 trillion in economic output. In the aftermath, everyone pointed fingers. Was it the bank's fault? The regulators? The government? The rating agencies? The answer is yes to all. The banks were reckless. Lehman, along with Citigroup, Merrill Lynch, Bear Stearns, and others, leveraged themselves to insane levels. They knowingly bought and sold toxic mortgages. They prioritized short-term bonuses over long-term stability. Dick Fuld made $480 million while steering Lehman into bankruptcy. Executives at other banks made similar fortunes. When the crisis hit, they walked away rich while shareholders, employees, and taxpayers paid the price. The rating agencies failed. Moody's and Standard & Poor's gave AAA ratings to mortgage securities that were junk. Why? They were paid by the banks issuing the securities. Conflict of interest was baked in. Agencies that gave harsh ratings lost business. Agencies that rubber-stamped deals got more fees. An internal Moody's email from 2007 released later admitted, "We sold our soul to the devil for revenue. The regulators failed." The Securities and Exchange Commission, tasked with overseeing investment banks, missed every warning sign. They knew Lehman's leverage was extreme but did nothing. The Federal Reserve, which regulated bank holding companies, did not intervene. The Office of the Comptroller of the Currency, overseeing national banks, was asleep at the wheel. Government policy contributed. The push for home ownership, while well-intentioned, created perverse incentives. Fannie Mae and Freddie Mac, under political pressure to buy more subprime loans, became huge buyers of toxic mortgages. The Gramm-Leach-Bliley Act of 1999 repealed Depression-era regulations, separating commercial banks from investment banks, allowing riskier behavior. The Commodity Futures Modernization Act of 2000 exempted derivatives from regulation, letting the credit default swap market explode with no oversight. But there is a deeper cause: incentives. On Wall Street, compensation was tied to short-term performance. Traders and executives who made big bets got big bonuses. If those bets went bad years later, it did not matter. The bonus was already paid. Risk was socialized, profits were privatized. As long as the music played, everyone kept dancing. Lehman Brothers' bankruptcy was the largest and most complex in history. Untangling $613 billion in assets, $900 billion in derivatives, and 7,000 subsidiaries across 50 countries took years. Creditors filed claims for over $1 trillion. The bankruptcy was handled by a team of lawyers led by Harvey Miller at Weil, Gotshal, and Manges. They sold Lehman's businesses piece by piece. Barclays bought Lehman's North American investment banking operations for $1.35 billion, getting the deal they could not complete before bankruptcy. Nomura bought Lehman's Asian and European operations. The asset sales brought in $70 billion, but creditors were still owed hundreds of billions. Lehman's estate went after anyone who had received payments before the bankruptcy. Clawback lawsuits targeted banks, hedge funds, even Lehman's own executives. By March 2022, after 13 years, the bankruptcy was finally closed. Creditors recovered about 50 cents on the dollar. Not terrible for a bankruptcy, but still billions in losses. For employees, the collapse was devastating. 25,000 people lost their jobs overnight. Many had their life savings in Lehman stock, which became worthless. One Lehman employee, who had worked there 28 years, saw her retirement account drop from $1.2 million to zero. Dick Fuld fared better. He kept his $100 million mansions in New York and Florida. He avoided criminal charges. In congressional testimony, he blamed short sellers, regulators, and bad luck. He expressed no remorse. When asked if he took responsibility, he deflected. Representative Henry Waxman asked, "Do you take any responsibility?" Fuld replied, "I feel horrible about what happened, but we tried our best." Waxman pressed, "Is that a yes or no?" Fuld said, "It is an explanation." The most haunting question about Lehman and the 2008 crisis is, why did nobody stop it? Regulators saw Lehman's leverage. Rating agencies knew mortgages were toxic. Investors knew housing prices were unsustainable. Yet the machine kept running until it exploded. Why? The answer is systemic incentives. Regulators who cracked down risked being blamed for killing the economy. Politicians who proposed stricter rules were lobbied into silence by Wall Street. Executives who raised alarms were sidelined. Journalists who warned of bubbles were dismissed as pessimists. The system rewarded optimism and punished skepticism. There were people who saw it coming. A few hedge fund managers like John Paulson and Michael Burry bet against the housing market and made billions. Their story was told in the book and movie The Big Short. But they were outliers, mocked as crazy until they were proven right. Inside Lehman, there were warnings. Risk managers flagged excessive leverage. Traders expressed concern about real estate exposure. But Dick Fuld and senior management dismissed them. Fuld believed in real estate. He believed housing prices would not fall nationwide, that such a thing had never happened. He was wrong. The deeper issue was moral hazard. After the government rescued Bear Stearns, the market believed all major banks were too big to fail. This created perverse incentives. Banks took bigger risks, knowing taxpayers would backstop losses. Paulson's decision to let Lehman fail was meant to prove the government would not always bail out reckless behavior. But it backfired. Lehman's collapse triggered such chaos that the government bailed out everyone else. AIG, Citigroup, Bank of America, all got taxpayer money. The moral hazard remained. While Lehman and other banks were building the house of cards, a few investors saw through the illusion and bet against them. Their story became the basis for Michael Lewis's book The Big Short, later adapted into an Oscar-winning film starring Christian Bale, Steve Carell, Ryan Gosling, and Brad Pitt. The main characters were real people. Michael Burry, a one-eyed former neurologist turned hedge fund manager, was among the first to spot the crisis. In 2005, Burry analyzed thousands of subprime mortgage bonds and realized they were garbage. Borrowers had no ability to repay. The bonds were rated AAA based on flawed models. Burry convinced Goldman Sachs and other banks to sell him credit default swaps on these bonds, essentially insurance that paid off if the bonds failed. The banks happily sold, thinking Burry was insane. Steve Eisman, a hedge fund manager portrayed in the book and film, also saw the fraud. Eisman visited mortgage lenders and saw loans being approved with no documentation. He met borrowers who had lied on applications and knew they could not pay. He shorted the entire sector. John Paulson, not related to Hank Paulson, ran a hedge fund that bought credit default swaps on mortgage securities. When the crisis hit, Paulson's fund made $15 billion in 2007 alone. Paulson personally made $4 billion, the largest single-year payout in Wall Street history. The irony is that these investors needed the banks to bet against. They bought credit default swaps from Lehman, AIG, and others. When Lehman collapsed, some of those swaps became worthless. The system was so interconnected that even those betting against it were at risk when it fell. After the crisis, the public demanded accountability. Surely executives who caused such destruction would face consequences. Surely fraud would be prosecuted. But it did not happen. The Department of Justice investigated banks for years. They found evidence of misconduct, fraudulent mortgage origination, misleading investors, rigging LIBOR interest rates. But almost nobody went to jail. Why? Prosecutors argued that proving criminal intent was hard. Banks paid fines but admitted no wrongdoing. Executives claimed ignorance. The fines were large on paper. Bank of America paid $16.65 billion. JP Morgan paid $13 billion. Citigroup paid $7 billion. In total, banks paid over $200 billion in fines and settlements. But for banks that made hundreds of billions during the boom, it was a cost of doing business. Shareholders paid the fines, not executives. Only one major banker went to prison. Kareem Sarageldin, a Credit Suisse executive who hid losses on mortgage bonds. He served 2 years. Countrywide CEO Angelo Mozilo paid $67.5 million, but faced no criminal charges. Lehman's Dick Fuld faced congressional hearings but no prosecution. AIG's executives walked free. The lack of accountability fueled public anger. The Occupy Wall Street movement in 2011 protested income inequality and corporate greed. The phrase "too big to fail" became a rallying cry. Politicians promised reform. The Dodd-Frank Wall Street Reform Act passed in 2010. It created the Consumer Financial Protection Bureau, imposed stress tests on banks, required higher capital levels, and restricted proprietary trading. But Wall Street lobbied to weaken enforcement. By 2018, parts of Dodd-Frank were rolled back. 15 years after Lehman's collapse, has Wall Street learned its lesson? The answer is mixed. On one hand, banks are safer. Capital levels are higher. Leverage is lower. Stress tests ensure banks can survive severe downturns. Regulators monitor systemic risks more closely. The financial system withstood the COVID-19 pandemic without a crisis, proof that reforms worked. On the other hand, moral hazard persists. Banks are bigger than in 2008. The four largest United States banks, JP Morgan, Bank of America, Citigroup, and Wells Fargo, control more assets than they did before the crisis. Too big to fail is more true now than ever. If another crisis hits, taxpayers will likely bail them out again. New risks have emerged. Shadow banking, financial activity outside regulated banks has grown. Private credit, cryptocurrency, leveraged loans all operate with less oversight. Another bubble could be building. Another Lehman could be lurking. The cultural lessons also remain unlearned. Wall Street still rewards short-term risk-taking. Executives still make fortunes regardless of long-term outcomes. The system still privatizes profits and socializes losses. Dick Fuld, now in his 70s, works at a boutique advisory firm. He gives occasional interviews, still blaming others for Lehman's collapse. He shows no remorse. In a 2010 interview, he said, "I wake up every night thinking, what could I have done differently?" But publicly, he remains defiant. The phrase Lehman moment entered the lexicon, meaning a sudden catastrophic failure that triggers wider collapse. Every financial scare since, from the European debt crisis to the COVID crash, prompts the question, Is this another Lehman moment? So far, governments have intervened to prevent it, but the ghost of Lehman haunts every crisis. The story of Lehman Brothers is a story of hubris. A 158-year-old institution, built on prudence, was destroyed by greed in less than a decade. Dick Fuld and his team believed they were smarter than the market. They believed leverage was a one-way bet. They believed housing prices could never fall nationwide. They were wrong. The collapse of Lehman Brothers on September 15th, 2008, was not just one bank failing. It was the moment the global financial system nearly died. $16 trillion in wealth vanished. 8.7 million Americans lost jobs. Millions lost homes. The Great Recession scarred a generation. The lessons are clear. First, leverage is dangerous. Borrowing $30 for every dollar you own multiplies gains, but it also multiplies losses. When the foundation cracks, the skyscraper collapses. Second, complexity hides risk. Collateralized debt obligations, credit default swaps, structured finance. These instruments were so complex that even executives did not understand them. Complexity is not sophistication. It is obfuscation. Third, incentives drive behavior. Wall Street's bonus culture rewarded short-term bets and punished caution. Until incentives align with long-term stability, crises will recur. Fourth, regulation matters. Deregulation enabled the crisis. Banks that were once partnerships risking partners' own money became public companies gambling with others' money. Oversight is not the enemy of markets. It is the foundation of trust. Fifth, nobody is too big to fail. Lehman proved that even giants can fall, but it also proved that letting them fall has catastrophic consequences. The solution is not bailouts. It is preventing firms from becoming so large and interconnected that their failure threatens the system. The house of cards that Lehman built took years to construct and hours to collapse. Gravity, it turns out, still exists. The question is whether we will remember that lesson the next time we are tempted to build skyscrapers on sand.